I'm excited to be here today. I'm going to be talking about the One Big Beautiful Bill Act, primarily focusing on the tax consequences as they relate to the manufacturing sector from that act that was passed this past July. Real quick, just to touch a little bit about who we are as a firm. Dugan and LePaca is a full service CPA firm located in DuPage County. We're located off of Winfield Road and Ferry Road in Warrenville. We've been around for over 50 years. We're a full service firm, so we offer accounting, assurance, tax services to the middle market and nonprofit organizations. We also have a wealth management arm that advises many clients on financial planning and other wealth management needs. Again, my name is Andrew Schmidt. I'm a principal here at Dugan and LePatka. I've been with the firm a little over 13 years now. I currently lead our tax practice, again, focusing on middle market, smaller size businesses as well. Companies we heavily deal with manufacturing and industrial based clients. Also work with a lot of service based companies as well, architecture and engineering firms, attorneys, doctor groups, things like that as well. So here's a look at kind of what we'll be talking about today. To set the stage, a lot of the provisions in the One Big Beautiful Bill Act, or I'll probably refer to it as OBB throughout the conversation, are some of the things are just extensions or expansions of existing law. They may have been law 5, 6 years ago that have certain things have begun to phase out. Many of those things have been restored as part of this recent bill. There are some new things in there as well that we'll touch on, specifically the bonus depreciation on qualified production property, basically an opportunity to accelerate depreciation significantly on commercial real estate that's used within the manufacturing sector. We'll touch on a little bit on some other tidbits and things that may be impactful to you as individuals and as business owners, and also look at what might be ahead in terms of upcoming legislation. So again, to set the stage, the OBB really, the objectives of it from a policy standpoint were to promote capital investment in U.S. manufacturing, incentivize domestic R&D, and overall simplify the tax treatment on some areas that are impactful to the manufacturing space. The current administration has obviously been very focused on domestic manufacturing and incentivizing manufacturing on U.S. soil. You'll see that some of the provisions in here definitely incentivize that. So what does it mean overall? Some of the big things that we'll cover. We have an extension and an expansion in cost recovery tools, so depreciation on equipment and machinery. And as I mentioned, the new provision on real estate that you're able to accelerate depreciation that can significantly improve short-term and long-term cash flow. One of the areas that I know has been discussed in this space has been research and development. From 2022 through 2024, there was a very unfavorable tax provision that required businesses to capitalize and amortize domestic and foreign R&D costs over either a 5 or 15 year period. This often had significant impact on companies' taxable income positions. That has been rolled back, and there's also some retroactive provisions in there to address costs from that 2022 through 2024 timeframe. And there's also an introduction and expansion and incentives on certain manufacturing industries, such as semiconductors and certain advanced manufacturing. We won't get into a whole lot of that today, but that's also included in the bill. I always like to talk about what was not included when there's a piece of legislation passed. There's a lot of headlines that get thrown out, especially before the bill gets passed and even after the bill is signed into law. So it's important, I think, to discuss what are some of those things that may have been proposed that did not make it into the final law. One of the things that was very heavily covered, I would say, in the news media is the state and local tax deduction cap that was put into place back in 2017 during the first Trump administration that cap individuals' ability to deduct their state and local taxes at $10,000 a year. Uh, on a related note, when that was put into place, many states, including the state of Illinois, put in a provision that allowed S corporation and partnerships, which are also referred to as pass-through entities, allows them to make an election to pay the state and local taxes on the profits from the business on behalf of their individual owners. And that was blessed by the IRS and the Treasury Department, allowing those business owners to essentially circumvent the $10,000 cap. There had been discussions about that being repealed or severely limited, especially in certain industries. That did not make it into the final bill. There's no limitation on use of this, so that will continue to be an option available to the companies that are structured as pass-through entities. The other thing that impacts pass-through entities is the 20% qualified business income deduction. This was put into place again back in 2017 with the first Trump administration and the Tax Cuts and Jobs Act. That's a deduction that pass-through business owners get on their share of the profits from the business. They're effectively able to carve off 20% of that from their taxable income each year. There had been a discussion about increasing that to as high as 23%. That did not end up coming to fruition. It remains 20%. It's been slightly expanded. There's some different phase outs and phase ins that relate to this that have been made a little bit more taxpayer friendly. But overall, the 20% deduction regime remains very similar. On the corporate side, the C corporation side, there had been a discussion about potentially lowering the statutory tax rate from 21% down to 15% specifically for US manufacturers. That is not in the bill. The 21% statutory rate remains the same, although there are additional incentives for corporations that can bring down that effective rate from that 21%. There's been no increase either. There was some discussion about an increase to the corporate tax rate, and at the individual level, a discussion on the quote unquote millionaires tax. So the top tax rate currently is 37% for individuals. There had been some discussion on increasing that to as high as 39.6% on individuals making. There was one proposal for over $1 million. Then there had been a discussion on a $5 million adjusted gross income threshold for that. Ultimately, that never made it into the final bill. The 37% remains the top marginal rate for all individuals. And then lastly, we see certain extenders, so things that are in the law currently that have specific expiration dates. None of those really made it into the bill other than a lot of the ones that we're going to talk about today. So one of the biggest ones that I wanted to call out for this group was the work opportunity tax credit. That is set to expire at the end of this year, pending additional legislation. And that credit is a federal tax credit for employers who hire individuals from certain groups that have historically been, difficult for people to find jobs. So things like, or folks like ex-felons, qualified veterans, members of the SNAP program as well. And then there's a number of different categories that folks are eligible for. So let's get into a little bit of the highlights for manufacturers. I wanted to start with some choice of entity considerations. This is always a thing that I think is important for businesses and business owners to be evaluating on an ongoing basis. Is how they're structured. Are they a C corporation? Are they a partnership? Are they a S corporation? And when new legislation comes out that can change the tax law, oftentimes that's a really good opportunity to evaluate your entity structure. And when you make a change to your entity structure, it can often come with different tax consequences. So it's important to consider those, obviously. But uh, thinking about your short term and long term goals, the choice of entity can often come into play. So, on that note, again, focusing on how the top rate now remains at 37% for individuals. So that directly impacts pass-through entity owners, owners of S corporations and partnerships. That 37% rate in the bracket structure from the Tax Cuts and Jobs Act in 2017, that has been made permanent. So there is no longer any cliff effect where at the end of a certain year, it'll revert back to the old rates. So it does provide a little bit of additional certainty in the law. Congress can obviously act to change that, but there's no set expiration on it. It also, again, makes permanent the 20% qualified business income deduction. This effectively means that the top marginal tax rate for U.S. manufacturers that are structured as pass-through entities is 29.6%. So even though the top rate is 37%, when you tack on this deduction, then the individual owner's top rate effectively becomes 29.6%. So when you look at it between pass-through entities and C corporations, pass-through entities only have that one layer of federal and state tax, whereas the C corporations are subject to double taxation. This is one of the things that was put into place with the Tax Cuts and Jobs Act to make pass-through entities continue to be a viable option with the decrease in the corporate tax rate from previously it was as high as 35%, and currently we're at that 21% rate. Um, Important here to also consider the state income tax effects. So for Illinois, pass-through entities are subject to a 1.5% tax, the entity level, and then the individual owners pay individual tax on their share of the profits at 4.95%. So a total top marginal rate of about 36% when you factor in the qualified business income deduction. On the flip side, C Corps, the state of Illinois has a 9.5% corporate rate. Um, so you can get as high from an effective rate standpoint after profits are distributed as high as 49% when you combine federal and Illinois. So important to consider both, how much profits the company is generating that are going to be distributed out to the owners versus reinvested to continue growth of the company, capital investments, and things like that. Those two things really come into play heavily when you're considering your choice of entity. One other area on the choice of entity side that this provision, the 1202 qualified small business stock, has been around since the early 90s. And it's been modified a couple times over the years, more recently in 2010. So this is the first time since then that there's been material changes to this provision in the law. Effectively, what it is it's for C corporations, domestic C corporations that issue stock to what's considered a qualified small business. It allows those shareholders to exclude up to 100% of their gain when they later sell the shares in that corporation. There's multiple requirements that have to be met. One of them, it has to be a domestic C corporation. The stock has to be originally issued by the corporation, so you can't have acquired it from an existing shareholder for you to be eligible. And under the old law, the gross assets from the company had to be below $50 million at the time of issuance and subsequent to any additional investment as part of the acquisition of those shares of stock. And one of the biggest requirements was the shares had to be held for at least 5 years for the shareholder to be eligible for this at a later date. So, what does the OBB do to the current law? It increases what was a minimum $10 million gain exclusion. So if you sold your shares for $5 million or a $5 million gain in a qualified small business, then that gain was 100% excludable from your taxable income. So it's a very powerful provision in the law, one of the very few that allows for a complete exclusion from income. That minimum gain now has gone from 10 million up to 15 million as part of this act. It also increases the gross asset threshold from 50 million to 75 million. And beginning in 2027, the that threshold will, for the first time, be adjusted for inflation each year. So it expands the number of businesses that could potentially be eligible for this. And I think probably the most impactful or potentially impactful area of this law is it adds additional exclusion amounts for different holding periods. So if you had stock acquired after 2010 and it was met all the other requirements, you had to hold the stock for at least 5 years in order to exclude 100% of the gain. If you held it for four, 100% of it was taxable, and so on and so forth. The OBB adds a partial exclusion for different holding periods. So if you held your stock for 3 years, the gain you can exclude is 50%. If you held it for 4 years, it's 75%. And then 5 years or more, you continue to be eligible for that 100% gain. So it adds some additional holding periods that could be attractive to certain investors and businesses um, that may want to influx some capital early on, but don't want to be a long-term shareholder. It's also important to note that for the 3 year and the 4 year holding periods, the portion of the gain that is not excluded from tax, so it is taxable income. Normally, a capital gain, a long term capital gain, is taxed at either 15 or 20%, depending on the individual marginal tax rate. When you have qualified small business stock, the gain that is included in your taxable income is subject to a higher rate of 28%. Jump into bonus depreciation and Section 179 expense. I think as kind of a refresher for those that don't know, both of these provisions are essentially accelerated depreciation provisions on capital assets, primarily most tangible personal properties. So equipment, machinery, office furniture, and fixtures are generally going to be eligible for both of these provisions. And then bonus depreciation also has a carve out for interior improvements to commercial real estate. Uh, Normally, that's a 15-year depreciable asset, would be eligible for bonus depreciation as well. Some key distinctions between the two: bonus depreciation is essentially an all or nothing thing in a given year. So if you have a whole bunch of machinery, $5 million of machinery that you acquire during the year, and you want to take bonus depreciation on it, you've got to take it on all of those assets. You can't pick and choose which ones, which may not be what you want to do in order to kind of spread out that deduction over a number of years. Section 179, on the other hand, you can pick and choose assets, but they come with different rules. So starting with bonus depreciation, that had been under the old law phasing down. 2025 was set to be at 40%. So if you acquired an asset for $100,000 and you took bonus depreciation on it, you would be able to deduct $40,000 in the first year. The OBB restores that back up to the 100% deduction in the first year. So any assets that are acquired and placed in service after January 19th are going to be eligible for 100% bonus again. Important to keep in mind if you have, as you're going into kind of the year end and doing some planning, if you have assets that you acquired, so meaning you paid for them or you entered into a contract to acquire them prior to January 19th, even if you place those assets into service after that date, they're not going to be eligible for the 100%. They're going to revert back to that old 40% law. So it's important to consider the timing if you had some crossover for some assets that were acquired in 24, but not placed in service until 2025. This is another provision that was made permanent. So unlike the old law where there was a phase down, the 100% is made permanent absent any additional congressional action. Section 179, again, very similar to bonus, but you can pick and choose which assets you want to take an expense on in the first year. And you can also choose how much of the total cost of the asset you want to claim Section 179 for. Unlike bonus, Section 179 is capped at certain thresholds, and it's also capped at your business's taxable income in a given year before Section 179. The OBB expands 179 for assets acquired after December 31st of 24. The maximum deduction in a given year has been increased from 1.25 million up to 2.5 million. Additionally, there's a phase out threshold that if you have total assets acquired in a given year that are above this threshold, the deduction, the max deduction of 2.5 begins to phase down dollar for dollar. So the threshold has been increased from about 3.1 million to 4 million starting in 2025. As a short example, if you acquired 5 million of assets eligible for 179 this year, your deduction, your maximum deduction would be reduced by the excess of that 5 over the $4 million phase out threshold. So you would have a maximum 179 deduction of 1.5 million. Some other just notes on this to make sure everybody is aware. Bonus depreciation is not allowed for Illinois income tax purposes. And most other states, I would say, also do not conform to the federal law. They require an adjustment on the state side. Whereas in the state of Illinois, Section 179 is allowed for state purposes. So it's important to consider not only the federal impact in the short term, but also the state impact, and also looking at what your multi-year impact of some of these elections are. It may not be as advantageous to claim accelerated depreciation early on if you have, forecast out for a couple of years and you have additional capital expenditures you need. Maybe you're looking at, years where you're going to have some heavy investment and your taxable income isn't going to be high to warrant those upfront deductions as much. The other piece to point out on the 100% bonus depreciation, that also makes cost segregation studies a lot more attractive. And as just high level, what those are is you acquire a piece of commercial real estate. Many of our clients are owner occupied companies. So the operating company ownership also owns the real estate separately that the company works or operates out of. So cost segregation studies, normally a piece of commercial real estate is depreciable over 39 years. With cost segregation studies, you can carve out 20, 30, sometimes as high as 40% of the cost of the asset and treat it as shorter depreciation lives, which also gives you the ability to claim that 100% bonus depreciation. So it can accelerate the deductions on the depreciation deductions on commercial real estate, which can provide some tax deferral and short-term cash flow influx. Next, we're going to talk about Section 174, which is research and development expensing. As I mentioned, the prior law, and this provision actually came from the 2017 Tax Cuts and Jobs Act that was passed during the first Trump administration. But the provision was delayed on when it was actually would actually go into effect until 2022. This was something that I think a lot of business owners were aware was coming down the pipe. The Congress, I think, was aware of it. There were multiple attempts to try to repeal it before it went into effect that ultimately never came to fruition. So in 2022, the requirement to now capitalize research and development costs and amortize them over 5 years went into effect. And this had a bit of a cliff impact, I think, to uh, a lot of companies that had heavy R&D, because in 2022, as an example, if you had $1 million of R&D expenditures that year, you're only able in that first year to deduct 1/10 of those costs. Even though it's a 5 year period, the year the in service date for those costs was automatically in the middle of the year. So effectively, you only got half of a year's worth of a deduction in the first year. So that's a $900,000 add back to taxable income, which can be very significant. And then on the foreign side, if you had R&D activities overseas, those costs were even worse, amortizable over a 15-year period. And in the manufacturing space, things like product development, product improvement, manufacturing process improvements, and um, investments in software to support the manufacturing process. A lot of those things are considered research and development under the tax law. And if you were investing heavily in those, I'm sure you saw the impact of this provision. So the new law, effective 1/1 of 2025, reverts back to the more favorable rules of those costs are deductible in full in the year you incur them. So you're no longer required to capitalize them. The exception to that is foreign R&D remains capitalized and amortized over a 15-year period. And there's also some options that are available for the costs that you incurred from 2022 through 2024 that you've been amortizing over a 5 year period. So you have costs that you have not fully deducted for tax purposes yet. Do you continue to amortize those, or what are your options there? Well, the law puts into place various options on how to handle these. One option is only available to small businesses. So small business is defined as a company that had gross receipts of $31 million or less on average from 2022 through 2024. If you were below that threshold, then you're likely eligible for this option. And that option is to go back and amend tax returns from 22, 23, and 24 and deduct the full cost of your R&D in those years. So obviously, if you had taxable income and a tax liability that year, this amendment is going to create refunds and immediate cash flow. And I caveat the immediate. I'll get to that in a short moment. Important deadlines on this. It's the main deadline is it's a year from the enactment of the bill. So July 6th of 2026, you would need to have completed the amended filings. And this is an all or nothing thing. You can't pick and choose which years you amend. You have to amend. If you're going to go back and amend, you're going to amend 24, 23, and 2022. However, there is another date to be aware of, which is the normal statute of limitations for filing an amended return for a refund is 3 years from the date you filed the return. So if you filed your 2022 return, you didn't file an extension, say you filed it on April 15th of 2023, 3 years from that date is April 15th of 2026, and that becomes the date that you need to complete these amendments. So it's important to keep those dates in mind if you are considering this option. The other paths that can be taken if you're either not eligible for that amendment option, or it's more beneficial for you to not go back and go through that exercise. One option is you take all of your unamortized costs from 22 through 24 and you deduct them all at once in 2025. Similarly, you can also elect to deduct half of those in 25 and half of those in 2026. Benefit here, it's a prospective adjustment. You don't have to go back and amend tax returns. Um, Fairly straightforward exercise. There's going to be some additional reporting required, uh, but much less burdensome from a compliance standpoint than going back and amending. I'll add that it's important to really think and model through the impact of these various options. Um, some of the things that can come into play with respect to any of the options. The first two relate to pass-through entities. And some of the clients we've modeled this out for, they have a very large R&D deduction in if they choose the go forward path of deducting everything in 25 and or 2026, um, to the point where we expect them to have a taxable loss in 2025. How much of that loss can actually be utilized by pass-through entity shareholder? Um, you can run into tax basis limitations. There's a rule on how much total loss you can deduct from your pass-through entity activities that could come into play. It could create a net operating loss that you get to carry forward. That net operating loss is limited to 80% of taxable income in the future. It also, many of clients that have R&D expenditures are also claiming the R&D tax credit. There's various limitations there that could impact the use of those credits. And then I think some of the biggest piece of this is compliance costs and timing of refunds. Uh, if you have a pass-through entity that has 10, 15 shareholders, then not only are you going to have to amend the corporate return, but each of the shareholders are going to have to amend their 1040s in order to benefit from this if that retroactive option is utilized. That can add up significantly. I know just the frustration of like having past tax returns redone can cause some anxiety with folks. So I think that's an area that should be heavily considered as part of this as well. And then with the IRS staffing cuts over the last year and now the recent government shutdown, it's anyone's guess when you're actually going to receive refunds if you do go back and amend prior year returns. Uh, we have some clients that we have filed amended returns for other reasons early in 2025, and they still haven't been processed by the IRS yet. So, and that's before the government shutdown happened. So I think that's an important consideration as well. Just because you file it doesn't mean you're going to get the cash right away. Next, we're going to talk about the interest expense limitation. Again, something that came into play with the Tax Cuts and Jobs Act in 2017. Uh, this is effectively a limit on the ability of a manufacturer or any company to deduct interest expense. The deduction is limited to 30% of adjusted taxable income. And from 2022 through 2024, adjusted taxable income was calculated after a deduction of depreciation and amortization. So manufacturers obviously have large capital needs that often have large depreciation and amortization deductions, where if they were subject to this limitation, their interest expense on any debt could be limited in terms of what they can use in a given year. The new law under OBB reverts back to the EBITDA calculation. So adjusted taxable income is actually calculated before subtracting depreciation and amortization. So that's going to be much more favorable to companies that have a lot of capital needs, but also are financing those needs through debt that has interest. Uh, Also important to note, not every business is subject to this limitation. That same $31 million gross receipts threshold that I mentioned earlier applies here as well. So if you're below that threshold, this limit doesn't apply at all. So one of the newest provisions that will be interesting to see more guidance on from the IRS and the Treasury Department on how this exactly will be implemented is the bonus depreciation on qualified production property. Effectively, what it is any portion of a non-residential piece of real estate used as an integral part of a qualified production activity with the original use of the property commencing with the taxpayer and meeting other various requirements would be eligible for a 100% deduction in the year that the real estate is placed in service. So this is going to apply to properties that are located in the United States. They're used directly in manufacturing, production, or refining activities. As I mentioned, it's new property to the taxpayer, and its construction began after January 19th of 2025, and the property is placed in service before January 1st of 2031. So property that is used primarily for office space, research and development, engineering, parking, software development, any other non-manufacturing or production activity would generally not be eligible for this provision. So I mentioned before that generally it has to be newly constructed property. However, there is a carve out for used property. Certain used property that's acquired can be eligible for this provision as long as it hasn't been used in a qualified production activity between January 1st of 2021 and May 12th of 2025, and it hasn't previously been used by the acquirer of the property. So I probably a common example that could come into play is a company that currently leases its manufacturing facility and has an opportunity to acquire the real estate. That's not going to be eligible for A, because it's already been used by the acquirer, and also it's been used as a qualified production activity during that time frame. This is an elective provision, so it is not something that is automatic, and you don't have to do it even if you're eligible. So you elect to claim this deduction, and it's a completely separate, even though it's considered bonus depreciation, it's considered a separate provision from bonus depreciation on machinery and equipment and other tangible property. There's also a recapture rule to be aware of. So if property ceases to be used in a production activity within 10 years of the original deduction, then taxable income is triggered as if the property was sold. Effectively, that means that any prior deduction is recaptured into income at that point in time. There's a lot of gray area in this. And as I mentioned, we're expecting hopefully fairly soon some additional guidance from the IRS and the Treasury Department on definitional clarities, certain provisions on how properties that are mixed use that have both manufacturing and production space, but also separate space for storage and office space, and what are the mechanics for allocating the costs between those qualified activities and non-qualified activities. And I think for a lot of companies that are heavy manufacturers, it's going to be a little bit more straightforward, but understanding what manufacturing and production, how that gets defined in the guidance will be important for other companies that maybe have a little bit lighter assembly and packaging activities versus true heavy manufacturing. Again, the eligible versus excluded space, that's going to be a big question. Whether or not, there's going to be like a safe harbor that if you have, say, less than, I'm just making up a number, but less than 10% of the property is for non-qualifying activities, then you can take the deduction on the full property. Or if you're going to have to get down to, square footage allocations and allocating between qualified and non-qualified space, the hope is that guidance on this will make that a little bit more clear. One of the biggest areas in my mind that I have questions on is the way the law reads currently is that the property, if it's eligible, has to be owned directly by the entity that is performing the manufacturing activities. So a lessor of the real estate to a manufacturing company would not be eligible for this currently. And most of our clients that are owner occupied, have owner occupied real estate, they hold that real estate in a separate entity. Often it's an LLC, um, and the manufacturing company pays rent to it. Under the plain reading of the law, those structures would not be eligible for this deduction. I expect Treasury to come out with some guidance that allows this in certain cases because this is a very common structure that we see often, and it primarily is not driven by tax reasons. It's driven by separating the operating activity and the real estate. So if we go under the assumption that those arrangements will be allowed, then there's additional questions and considerations that someone looking to take advantage of this provision would need to consider. Uh, One of the big things is when you have a rental real estate activity, if it generates a taxable loss during the year and that loss flows out to its partners or shareholders in that flow through entity, the loss from the depreciation is going to be considered passive loss. So what that means is if you have a manufacturing business that is also a pass-through entity and the manufacturing profits flow on to the individual shareholders' tax returns, the loss from the real estate activity that's being generated from this accelerated depreciation would not be able to offset against that manufacturing income. Um, and it would also not be able to offset owner's W-2 wages or other investment income. So that's an important area to consider when modeling out what are the actual real-time cash flow impacts of this provision once you determine you are eligible. I think that's an important area to consider. Wanted to highlight real quick the National Association of Manufacturers. They wrote a letter to the Treasury Department on October 7th, effectively asking for the guidance that I've been mentioning, specifically around some of the things that we just talked about. One of the things here is if you have an existing facility that you substantially renovate or expand, are those costs eligible, or does it have to be a completely brand new facility? The letter here asks for guidance on that. It also asks for guidance on the methodology for allocating between qualified and non-qualified space. And then the one I just mentioned on intercompany leasing arrangements. They ask that the Treasury allow these structures to qualify since they are very common structures. A couple international provisions. There wasn't a whole lot of changes to these, but they did establish slightly different rates. The first is on the global intangible low tax income, or GILTI as it's referred to. This is effectively for any US shareholders. That could be a corporation or it could be a individual that has an ownership interest in a foreign corporation that is considered a controlled foreign corporation. So the US shareholders effectively control it. This was put into place again back in 2017, and it's designed to discourage companies from shifting profits into lower tax jurisdictions. And effectively, what it does is it taxes certain foreign earnings currently to US shareholders, even if those profits haven't been distributed out of the foreign corporation. Uh, so the effective rate, you had to include, there's a calculation to include a certain portion of those earnings, but then there was effectively a deduction off of those earnings as well. That made the tax rate on this portion of your income equal to 10.5%. That had been set to increase to as high as 13.125%. The OBB sets that rate at 12.6%. And that also is another thing that is made permanent. The other foreign related provision, and this applies to any C corporations that are US based corporations that have significant export sales of either goods or services. C corporations that have export sales are eligible for a deduction for um, a certain amount of those export sales on their corporate tax return. And that effectively reduces the tax rate on profits from those export sales from the statutory 21% down to 13.1% under the old law. That had been set to increase to 16.4. That has now been set at a 14% rate. So it's effectively a haircut of about 7% on your effective tax rate on those foreign sales. So the provision is designed for to encourage U.S. companies from keeping their intangible assets within the United States, uh, as opposed to keeping them overseas. So it keeps the profits in the United States, but it incentivizes companies that are exporting to other countries. The other thing that the OBB did was it rolled back energy related incentives. A lot of these provisions were put into place years ago and expanded upon during the Biden administration. Um, Many of them were not set to expire until 2032. Uh, they have now been significantly accelerated on when those credits and provisions will sunset. So wind and solar, probably the biggest impacted. Those projects now must begin construction within 1 year of passage of the bill, July 4th, 2025, and be placed in service by December 31st of 27. And that's in order to claim either the clean production credit, which is a credit on the production of clean energy, or there's also the clean electricity investment credit, which is a credit tied to the cost of the energy property that was constructed and placed in service. Prior to when these phase out completely, there's also now an increase in how much of the actual property needs to have been made from US manufactured components. So that used to be lower thresholds, now has been bumped up even higher to encourage manufacturing of these pieces of property in the United States. The other one that's been curtailed has been the Section 179D deduction. This deduction is available to any commercial building owners that install energy efficient improvements to the property. This could be updated HVAC systems, high efficiency lighting, or enhanced building envelopes. Nice incentive too for those in the architecture and design businesses that work on governmental buildings because or nonprofits because those agencies don't pay tax, so they're able to allocate that deduction to the primary designer. That deduction has been phased out a number of times over the years and been brought back. It did not have an expiration date previously. It's now been set to expire for projects that begin construction after June 30th of 2026. So an important date to keep in mind if you have any renovation plans that may be eligible for this deduction. No tax on overtime. This one really applies to the individual employee, but there's also some areas to be aware of for the employer. What it is a tax deduction for individuals that receive certain overtime pay. This is effective for tax years 2025 through 2028. And The deduction that the employee gets is the half portion of their time and a half that they get paid for overtime as required by the Fair Labor Standards Act. And the deduction must, or the amount must exceed the employee's hourly rate. So an employee that has $10,000 of overtime pay during the year, they can deduct that as a single individual up to as much as 12,500. Married filing joint return, they can deduct as high as 25,000. It does begin to phase out for higher income earners. So for a single individual, once you hit 150,000 of income, then that deduction begins to phase out, and 300,000 for married filing joint. The Treasury Department actually issued guidance yesterday that employers that have workers that have qualified overtime, they won't be penalized for not separately providing information to the employee for 2025. That is one of the requirements of this law, is that the employer has to issue information to the employee on how much overtime pay they had that is actually eligible for the deduction. The IRS has already announced they're not modifying the Form W-2 for tax year 2025 to support this, but the employer is still required to furnish information to the employee that summarizes their overtime totals. As of today, there hasn't been any guidance specifically on what that means, but I would expect some to come over the next month or two that provides a little bit of guidance on this. But I think it's important to, if you have employees with overtime pay, making sure that's properly set up in your payroll systems so you can easily pull that information should the employee request it. A couple other tidbits from the law. The estate and gift tax exemption that was set to revert from about 13.9 million to 7 million starting in 2026 has been extended at a $15 million amount. Effectively, that means that during your lifetime and when you pass away, you can leave up to $15 million to your heirs, free of estate tax, at least on the federal side. There had been some talk about that reverting back to the 7 million and not getting extended, but ultimately it made it into the final bill. So that's favorable when you're thinking about estate planning, and if you have a family-owned business and how you want to transfer that down potentially to the next generation. This can be a key component of that. It's also important to keep in mind Illinois has its own separate estate tax, which has a much lower threshold, and it's different than federal. Federal is an exemption, whereas Illinois, once you hit that $4 million, your entire estate becomes taxable. SALT deduction, I mentioned that earlier. The deduction cap increased from 10,000 to 40,000, effective for tax years after 2024. That will expire at the end of 2029. And this one is important if your income is in that $500,000 to $600,000 range as a married filing joint taxpayer. That deduction begins to phase down significantly by 30% of your income over that $500,000 threshold. Once you get to 600,000, the deduction again is capped at the $10,000. So that can have a significant effective tax rate cliff on you if you're in that range. So it's important to monitor that. A couple other provisions available for employers to offer to employees: paid family medical leave credit. That's was enacted a few years back. It's been expanded now. It allows employers a tax credit, a federal tax credit of between 12.5% and 25% of wages paid to employees that are on FMLA. And if your company has a insurance policy that pays FMLA benefits, the premiums paid toward that policy are also eligible as part of that credit calculation. The percentage varies depending on how much of an employee's regular pay is actually paid during the FMLA time. Dependent care assistant, that allows for employees to pay for childcare effectively on a pre-tax basis. They withhold from their paychecks on a pre-tax basis and then get reimbursed for qualified childcare costs. That's been increased from 5,000 to 7,500 for tax years beginning after 2025. And then from a reporting standpoint, 1099 reporting for independent contractors. Historically, that threshold where you're required to issue a 1099 was $600. That has now been bumped to $2,000 for tax years beginning after 2025. It will also be indexed for inflation going forward as well. So that $2,000 will continue to increase. And important to note that's for 1099s that'll be filed in 2027. So for tax year 2026. So a quick look at kind of what might be ahead. As I mentioned, no tax on overtime and no tax on tips. Those were two, I think, signature things that the administration put in the law. There's been some guidance issued on the tips side of things, not as much on overtime, expecting additional guidance both from how an employee is supposed to deduct this on their return, as well as what information the employer needs to be providing to support that. Qualified production property, 100% bonus depreciation on real estate. That one is an area where there's significant guidance needed to clarify a lot of pieces of that portion of the statute. Um, that'll be a real key one for those considering either expansion of real estate or acquiring or constructing newer real estate related to manufacturing activities. There's been talks about a possible second reconciliation bill in Congress in 2026. Everything that I've seen and read indicates that that's going to be uh, more focused on spending and regulatory reforms than it is on newer tax policy. But there can always be some tax things that end up getting thrown in there or corrections from this past legislation. So it'll be important to monitor that. And then just as in general, like changes to some of these provisions that are in the bill still require that additional guidance in order to implement correctly. Mentioned before, bonus depreciation, 179, the EBITDA threshold for the interest expense limitation, all of those were made permanent, provides a lot more certainty when it comes to long-term tax planning. That you may have not had when you have that kind of expiration date on those, and will they or will they not extend them or not. So having that in there should provide some more comfort and certainty when it comes to tax planning. As we all know, Congress is very highly divided right now. So even with some of those permanent provisions, the election outcomes in 26 and 28 will definitely shape future tax priorities. There's still that possibility that if a new administration comes in, different priorities, that they look to repeal some of the provisions that were in this bill. So there's still that level of uncertainty, just not as much as when you've got those expiration dates. And then lastly, just touching on the IRS and administrative delays. The IRS has cut about 25% of its workforce since the beginning of 2025. So 102,000 employees down to 76,000. They've continued to lay off some additional employees during the government shutdown. That's going to significantly impact tax compliance going forward. So, continue to expect delays if you've got an outstanding issue with the IRS. Anticipate delays in getting responses and being able to get through to the IRS on the phone. Basically, this is a message: be kind to your tax advisors. They're dealing with the same headaches when it comes to this. So, and that's also important, as I mentioned earlier, with respect to that R&D option. When you're looking at, do I want to amend tax returns for prior years? Well, it could take, literally years for some of those amended returns to process due to some of these changes. And that's it. I know we don't have a lot of time for questions, but if there were any questions, I'd be happy to talk through them. And my contact information is here. I'm happy to have a conversation with anybody that has any questions or scenarios that they just want to talk through and get some advice or second opinion on things, and answer any questions related to this. So again, I appreciate everybody being here today, and hopefully you've got some good takeaways from this.